Wellspire Summer 2023 Market Update and Outlook. I'm Chris Maxey, Chief Market Strategist, joined by my colleague Dimitri Katznelson, Deputy CIO. So, Dimitri, a lot's been going on in 2023. Obviously, a lot of it is quite a bit different than what we saw in 2022. Why don't you break down what's going on this year relative to last year for us?
Sure. I mean, what a difference a year makes. Just to remind folks, last year, mid-year, stocks were down 20%. Bonds were off 10, which would have already made it the worst year on record, and it got, frankly, progressively worse towards year end. At the same time, inflation was running rampant. Year-over-year inflation was pushing 9%. Oil prices had just went from $75 a barrel to 110 plus at points during the second quarter. So a lot of things were going wrong for markets last year. Fast forward to today, we're looking at the S&P up double digits. We're looking at bonds being up low single digits. We're seeing oil prices come all the way back down to even below the levels we saw early at the late 2021, early 2022. And things have obviously gotten a bit better. And if you think about how we got there, it really has been whatever worked last year is not working this year and vice versa. So if you think not many things worked last year, frankly, but the things that did work, if you were tied to energy and commodities, if you had any focus or exposure to dividend payers, they tended to perform better than non-payers last year, and definitely much better than the growthier names that we've all come to know, right? The names that dominate the S&P 500 index. Fast forward to this year, the exact opposite. Dividend payers are frankly down for the year, whereas the things that are doing well are very growthy names that have any attachment, whether directly or indirectly, to artificial intelligence. We see those stocks doing really, really well this year in a complete reversal of what we saw in 2022. So in evaluating some of these changes, Chris, I know you've been paying attention to really the evolving dynamics of some of the numbers behind all of this.
Yeah, so Dimitri, one of the things that we've spent a lot of time thinking about is this notion of rate of change as opposed to the absolute level. And what I mean by that is so many of us are familiar with what the absolute level of interest rates is at the moment and what the absolute level of inflation is at the moment. But the reality is the market is always looking forward. And as you think about the market, it does not like rate of change that is accelerated. The best way to think about this is throughout 2022, right, the Federal Reserve was raising interest rates at a very accelerated rate, going from 0 to above 5% in less than 18 months. We hadn't seen anything like that in more than 4 decades. And so as you think about what the market was trying to digest at that point in time, it was something pretty much unprecedented over these last 4 or 5 decades. And the same is true of inflation, right? Inflation peaked at 9% last year, but we had a very sudden, rapid uptick in inflation based on the things that you were describing earlier, such as oil prices going higher somewhat unexpectedly. The inflation story has slowed, and we're now seeing that decelerate. And so as much as anything, interest rates, that rate of change is slowing. Inflation, that rate of change is slowing. These are really positive dynamics and developments for the market, and that's why we see a greater sense of calm, stability, and optimism as we begin to look forward. So, Dimitri, we've talked and covered a lot of ground about what's taken place in these first 6 months. Now, the question naturally is going to arise, all right, with inflation in a better place, with interest rates beginning to stabilize, what comes next in the second half of the year, and what are the things that advisors, clients, and everybody else in this economy needs to be paying attention to?
Absolutely. Well, you mentioned interest rates. That's actually a good place to start. We've written about this a couple of times as of late. We haven't seen interest rates this high since before the financial crisis in 08-09. So just clipping a yield on your bond portfolio is something we're frankly excited about. And as our clients tend to be savers and have savings in their portfolios, that is something that we haven't been this excited for many, many years. We're obviously looking at other things, fundamentals of the equity market, fundamentals of the bond markets, all those things that Chris touched on, inflation, interest rates. We're also keeping an eye out on things happening overseas. I think one area that's been in the headlines, but also not in the headlines for the right and wrong reasons, is China. It's a market that's actually down for the year, and some would not have expected that, given that if you look at the world at large, where artificial intelligence and technology is being rewarded, China is one of the few markets outside of the US that has a good concentration of those companies. We know about the headlines between US and China, but there are other fundamental things happening there with regards to a slower reopening post-COVID. There's actually a pretty high unemployment rate for that 16 to 24-year-old cohort, 20% there, 5% here. So there are probably another 12 to 18 months before they start to accelerate the spending, accelerate the rebounds that we've seen in the US and Europe, but definitely a market that struggled this year.
Thank you everyone for joining us. We appreciate you tuning into our summer 2023 market update and outlook. If you do have any questions, please reach out to your advisor, reach out to our investment team. We're always ready to answer and address any concerns or questions that you might have. We know that many of these topics are present and top of mind for people, and we're happy to discuss them. With that, thank you. We'll look forward to talking to you again in a few months.